Hey everybody, this is Kevin, a CPA that does financial planning. Today I wanted to talk with you about charitable giving. So right now we're in that period between Thanksgiving and for me Christmas, for others other holidays. But this is a time of year where many of us reflect on some of the blessings and other good things in our life, and we want to help others. So there absolutely is a best way to give. So before I get to that though, let me first state that I do realize now, after a number of years of working in tax and working with people with money, that the primary reason why people give has to do with charitable inclination and not because of taxes. So the reason why I think it's so important, though, for people that are high income to give a certain way is because you can give more. It's that simple. And I'll show you an example in a second of giving more by giving in a strategic way. So really the most important thing is setting up a charitable plan as part of your financial plan. And so Charlie and I are available from now till the end of the year. We're available all times of the year to talk with you about this. But there's a few strategies here, and this comes from the white paper for the best way to invest for high income investors. It's called the Roadmap for High Income Investors. So the first strategy is donating appreciated securities. So again, human beings, we have a difficult time with mental accounting. We don't think about things in certain ways. And let me just frame this for you. So we have cash in one pocket, and we have a brokerage account that has appreciated stocks, bonds, funds, whatever. Again, it has to be an after-tax or taxable account. But we give money, we give cash away, and yet we have these investments that have appreciated. Now, the only way we can turn these investments into something that we can spend is to do what? Is to sell them, and then we have to pay taxes. So instead of having capital gains tax of 15, 20, or up to 23.8% when you include some Medicare surtax in there, instead of doing that, what you can do is give away the appreciated security, have the charity or your church sell the appreciated security. So that's the first strategy, and I'll show you an example of that in a few moments. The next is giving to a donor-advised fund. So a donor-advised fund is a little tricky to understand, but really the main point here is that you can give away, I believe it's up to 30% of your adjusted gross income to a donor-advised fund in the current year. And then when the money's in the donor-advised fund, okay, it's a Schwab charitable or a Vanguard charitable or a Fidelity charitable, that money has been given away, but you've not actually given it to the third-party charity yet. So you can take all the tax deduction in 2017, for example, and then you can have them give the money to the actual charities next year, year after, whenever you like. You can also grow that money. So a donor-advised fund gives you a current deduction in the current year, but allows you to give the money away. And these have gotten extremely popular, and they've really replaced, for many high-income people, they've replaced the private foundation. Now, it is more swagger to have a private foundation, and if you're really high net worth, high income and high net worth, it might be a great idea to set one of these up. But the donor-advised funds really replaced it for a lot of folks. So the final idea that I want to share with you, and these are not the only ideas, but these are some of the main ones that we use, is gifting your required minimum distribution. Now, that's an RMD, and it's called a qualified charitable distribution, a QCD. So instead of taking your RMD, if you don't need to use it in the current year, instead of taking it into your possession and paying tax on it, what you do is you just tell us, and we tell Charles Schwab what amount of money to send to you. It's going to be made out to your charity, though, and then you will give that to your charity, and that way it will not be included in the income in the current year. So again, this is for people that must take out required minimum distributions and don't need the money. And so by doing this QCD, you can lower your income by that same amount. So let me give you the example now of how giving away intelligently allows you to give away more. Okay, so in the left hand here, what you do is you give away cash. Okay, right here, the $39.60, and all we're doing here is we're taking $10,000 and giving it away in cash, and we're pretending it's never this easy with tax, but we're pretending you're in the 39.6% tax bracket, so you're getting $3,960 off your taxes. Again, it's never this simple. We just made it simple. So that's the benefit you're getting by giving it away. So if you give away 10,000, really you could give away 13,960 when you look at the tax benefit of it. So you can give away more if you think about the tax benefit. Now, what we do here is instead of giving away cash, we give away an appreciated security. So we're still getting the 3960 tax benefit if we're in the 39.6% tax bracket, but we're also not having to realize that $600 capital gains tax savings. So by giving away a stock worth $10,000, we actually have $4,560 worth of benefit that we can give away extra. So again, these strategies are out there. I'm happy, Charlie's happy to talk with you about these strategies. It's a great thing to be able to earn money and to be able to share those with others. And again, if you want to talk about these strategies, we're open to now or in the new year. So thanks so much for watching. Again, Kevin, a CPA that does financial planning with Leading Edge Financial Planning. Thanks.